Okay, welcome to today's webinar. We are today focusing on a trading strategy slash entry technique that I rather lengthily called lower time frame trendline break trading strategy. The title is lengthy, but actually the strategy itself is super simple, and it's, as is the case with a few of these webinars I've done, it's not really a strategy in of itself. It's more of a kind of entry technique, but that is key to successful trading. Have an entry technique that you can rely on, that you have a fixed process that you can use. So this strategy does occur on different time frames, but the general idea is that it's a trend following technique, although it can also be used in a trading range. So I think the slides I've got today are fairly minimal, fairly straightforward, just reflecting how simple the idea of this strategy is. Then we're going to jump through to the trading platform just so we can go over some more specifics. I've got a pre-planned example in the platform with dollar yen, just because it's been quite a nice trending market at the moment, so obviously that provides a pretty useful, idealistic example of how this can work in a trending environment. But if any of you guys are trading a current market that you want to see how this trendline technique might have been applied in the past and going forward, then just chuck it in the questions box, and I'll try and cover that too. Obviously, I won't have anything prepped, but it'll be more of a free-flowing live example. So we're going to first just cover how to draw the trend line, question how it works, how you apply it, go through some textbook examples, and then the platform. So this is all super obvious. I'm assuming most of you are familiar with this, but if not, it's a good refresher. The trend line is obviously just a way to define a trend in the market. Generally speaking, we've got an uptrend, a downtrend, or a no trending or sideways trending market. Sometimes you see quite an even flow of highs and lows being formed, so that actually you can connect the bottoms, so connect the lows to form a rising trend line. Or in the case of a downtrend, you can connect the highs in a kind of even way that's represented by this straight trend line. So these are obviously pretty idealistic trend lines that we've kind of drawn on here, that I sourced off the internet, sourced these diagrams off the internet. But this is the kind of concept we're using here. The one, I think, major rule of thumb is that you need 3 touches on the trend line for it to be valid. So, you know, it's not really a trend if you've just had one low formed and then one higher low formed. You know, that can happen in any sequence of events. So when you get that third low in an uptrend, that's when you know it's is indeed an uptrend, and likewise for the downtrend. The other one is that if the trend line is too flat, then there's quite a good chance that it just kind of flops over into a sideways trend, and the trend line is just too easily taken out because it's too close to being just a support or resistance line rather than a trend line. And if it's too steep, then the trend is sort of by its nature very fast, because obviously the lows are happening very high above the previous low to create that angle, and it just makes the trend sort of unsustainable, and then thus it makes the trend line a bit unreliable. So actually something around 45 degrees is about perfect when you're talking about trend lines. So this is the same slide as actually used in some of the other webinars, but just to emphasize the point that this isn't an entry trigger, so it's not meant to be an entire trading system by itself. The idea is you want to get into the market long or short based on your other analysis, and you just need a trigger of how to get in. So if you time it correctly, this is a kind of confirmation of a bounce in an uptrend, or at the end of a bounce in a downtrend, or the end of a dip in an uptrend. So, and you've just the trend line break is the confirmation that actually that trend has ended. that correction has ended or that bounce has ended. So the upshot of all that is that you need the background analysis to decide to place this trade. If you just take every signal, it's not as effective. So what is the general concept here? So the idea is that we've observed that price is in a trend, and we want to find the most optimal places to jump on board that trend. Now, this particular technique is sort of a breakout technique, but it's not. It's a bit of a hybrid of a breakout and a pullback strategy. I would say it's more of a pullback strategy. So the idea being here, and this diagram I've taken from the classic technical analysis book, which is Technical Analysis Explained by Martin Pring. He was talking about a sort of multi-year bull market when he talks about the primary uptrend. And so these corrections in themselves could be a few months or even a year. But obviously this same concept can be applied to day trading, where maybe the primary uptrend that he's referred to has actually only been in place a couple of hours and you're actually trading very minute pullbacks. But this is the same idea, is that this is generally the kind of the way the market pulls together. And what we want to do, obviously we've had that surge up, the market's dipping, we want to kind of jump in board ready for this leg. And then with the idea that it's trending, you know, we want to jump in board obviously towards the end of this leg in order to capture that leg. So in the example of this 1, 2, 3, 4, 5 kind of idea, we want to basically somehow call the end of 2 to capture 3, and we want to call the end of 4 to capture 5. If it's a breakout technique, then you're waiting for a break above the end of 1 or above the end of 3 in order to, but obviously there's not always necessarily a lot left after that break, although the signal is a bit more clear cut when you do. So the idea is that we jump down to sometimes a smaller time frame in order to capture where this little small trend is breaking to the top side to capture the longer term uptrend. So as we've said in this, I've written here in terms of the concept, we've observed that price is trending. We wait for a smaller time frame trend against this trend. So in Pring's terms, we wait for the secondary action to go against the primary trend, and then we place a trade as soon as this smaller time frame trade reverses. So here's my bit of artistry for defining how we might look at this. So the idea being that this is an uptrend, and so here I've just added more detail, but it's just the same as this first pullback, but I've just added the detail to explain that even in here that, you know, there's going to be more detail, but obviously I've just drawn straight lines for simplicity reasons. But the idea is that this is the kind of longer term trend, which is upwards, and that's the direction we want to be trading. But this little trend was obviously downwards, and we're waiting for the break of that trend line to trade this upwards trend. Same thing with the downtrend. So I assume this is all making sense so far, right? So we can also use this idea in a sideways range. Again, another bit of artistry. It's not as reliable, but it, you know, if you are feeling confident about the bottom of the sideways range, or indeed the top, and you're just looking for a bit of confirmation, you've seen a bit of a bounce off the bottom of the range, and you want to feel more confident that the bottom of the range is in fact holding, then you can apply this same technique. But it's more likely to get this kind of thing where, yeah, maybe you're in the profits and then suddenly it all reverses and then it comes back to the line again and you have to sit in a bunch of losses and the market's very choppy. But hopefully if your ultimate analysis, which is deciding that that's the support, if that support is in fact right, then, you know, ultimately you'll be proven correct, and hopefully have a winning trade provided your risk management's okay. So in order to increase the odds on taking these particular trades, it's important to combine it with other forms of analysis. So first and foremost, defining that longer term trend. Secondly, something I like to use is fractals, and also moving averages and how these patterns interact with the moving averages. reversal price patterns and candlestick patterns. So it's pointless me trying to explain without showing, so I'm going to jump into the trading platform to kind of demonstrate some of these ideas. And then almost above and beyond anything else is just to use money and risk management techniques so that you can kind of limit your risk when this technique inevitably doesn't work. And there are certain scenarios which, again, I'm hoping to kind of go through here where different order types might be needed, in order to kind of manage your risk in the situation. Right, so let's have a look at the LCG Trader. Yeah, here's dollar yen, as I mentioned. Let's get rid of everything else. So I'm starting at this area up here. We've had a prolonged sideways movement. This is the weekly chart, by the way. A long sideways movement, a fairly kind of clear-cut area of support, and then we have a big weekly candlestick chart which takes the price below the 50-day and the 50-week and 20-week moving average, which it hasn't been below since this big bullish candle over here. So all been a sort of fairly bullish market up here, but then maybe, obviously with the benefit of hindsight, we decide at this point that actually the market's starting to look a bit soft. Now I'll put this line in there out of a matter of interest just to show I'm, I'm not kind of making it all up as I go along. That obviously would have been, you've been looking at that as a key area of support as well. And then again, when that support broke, you had extra evidence that we were in for perhaps in for a bigger downtrend. So we jump down to the daily chart. So this is this support that gave way. Here's that big daily break lower. Now at this point we're well below the daily and the 50-day moving average. The market starts, has that big lower day, drops. Now this particular technique doesn't really come into play during this period of time because the market's just dropping every single day and it really isn't having any kind of bounce. So this technique doesn't come into play for that period. What we're waiting for is some sort of correction and then a trend resumption. So different techniques need to be employed during this sort of more extreme part of the trend. So then you can see that actually the way this trend worked out is that, I've kind of pre-drawn some lines in here, is that actually we had a little kind of miniature trend going up here which eventually broke to the downside. And then the same situation here where we actually had some trend lines that we could draw. So here's two lows here, here's a third low, there's one down here as well which was already below the break. So we can draw this rising trend line which goes against where we believe the market's headed based on our kind of longer term analysis, break of this support up here, break of this support here, etc. The moving averages are pointing down. So the overall trend is down, but nonetheless we've had these periods where actually the price is making higher highs on the candlesticks. So in this particular scenario, actually you can use this technique on using the daily swings. But you'll see in a minute that when we drill down to a lower time frame, there actually opens up more opportunities and better timed opportunities to take advantage of the downtrend. And you can see I've kind of pre-drawn a bunch of them in. So you can see the little dots that I've got on the screen. I mentioned fractals. So I quite like those because they just help you define where the swing has taken place in order to define where you're drawing the lows in your uptrend lines at this point. So you can see there was a couple there, and then you could and then you can see there's one there, so you can actually adjust it. So it depends. So something I'm gonna highlight on a lower time frame in a minute is it depends on your entry technique as to how you readjust your trend lines as well. So let's jump down to the 4-hour time frame. So the way I typically tend to do this is that if you're trading a daily trend, I'll be looking for 4-hour counter trend lines. And if I'm trading a 4-hour chart, I'll be looking for 1 hour counter trend lines. 1 hourly trade, be looking more for like 15 minutes. So there's that rule of 4 basically in terms of the kind of multiple time frames that you're using. So then you can see here, this is that bearish daily candlestick within a few 4-hour candlesticks. And as you can see, yeah, it's just pullbacks within the 4-hour chart, but it's lower lows, lower highs being formed, but no higher highs and higher lows, i.e. the 4-hour trend is not reversed. The 4-hour trend is in line with the daily trend at this point. So this particular technique does not come into play until we get to here. You can start to see the trend starts to lose a bit of momentum. It can't really close below that previous low. And then we get that big move up above the 4-hour 20 period moving average. And then indeed we kind of stall along that average and jump to the top side. And you see that we actually stall around that 50 period moving average on the 4-hour chart. But by that point, we're able to draw this counter trend line. And you can see that actually it gives us not such a bad entry technique where the price does roll over. But in fact, ultimately, it doesn't take out that previous low. So depending on how you're managing your trade, that could be a scratch. Or I don't think it would probably be a loss. Could say your entry, say you're entering when the trend line has been broken, be about here maybe, say 110.95. You'd probably want your stop above the previous swing, which is, you know, this candlestick here, and you can see that actually just about the market held that price level and then rolled over again. But depending on how you manage that trade, you may have to find yourself with a scratch or a small loss, and then you're waiting for the next opportunity. So then you see that actually the market makes another rising trend line here. And this time, the market, the idea of the break is supported by this large bearish looking candlestick pattern here. So actually the candlestick pattern gives you a little bit more confidence. It's a candlestick pattern, and it's, you know, so it's a reversal pattern of sorts, a very short-term double top where we had that high there, and then the second high on the double top, and then the breakdown, and then this very bearish looking candlestick, which takes you down through, and then obviously it's the final point of reference. You've got this daily rising trend line, which also breaks down as well. And then, you know, with those two things, all those factors combined, the market really rolls over. And obviously, bearing in mind, you know, I'd drawn this long-term support up here, but obviously where the market stalled out is actually just above the kind of 110 number as well. So once we'd started rolling heavily into 110, that's when the market really gave, really fell away. And then you can see here, the market really drops suddenly, but there's no counter trends going on. It's all just high highs, lower lows, lower highs. And then we finally do get a high put in here. You can see it's not the most convincing low. And then we do get a reversal pattern here, but it doesn't take us down to the previous low. And in fact, probably on this particular example, we do get stopped out. Then the market does trade a fair bit higher. And it would be tempting if you were just looking at the 4-hour time frame to think, oh, this trend is reversed. We're now dealing with an uptrend because we're above this 50 period moving average. And you can see how people are trying to buy this rising trend line. And even when the trend line drops, you can see, look at this candlestick here. That's people buying on the 20 period moving average on the 4-hour chart, hoping for the uptrend to resume. But then paying attention to the fact on the longer term basis, if we look on our 4-hour trend at that point, on our daily trend, we're even below the 20 period moving average at this space in time. So it's nothing close to an uptrend on the longer term basis. But if you're just looking at that 4-hour chart, you'd be tempted into thinking it was. So then if you keep your cool and you keep focusing on the fact that you're looking for these up trend line breaks to the downside, then eventually you get one. The market does roll over slightly, but it kind of stalls out here, doesn't get down to that previous low. But based on your entry technique or when your stop or where your stop loss is, you just have to weather, you know, maybe your entry's there, depends where your stop is. You can see how this works, right? Where you had the little candlestick before the break, and actually that's where the market comes up to test it. So depending on where your stop was above this candlestick, you're either in the trade or you're stopped out, in which case you're again looking for a rising trend line to break. And in this case, you get another opportunity here, or indeed a kind of flatter opportunity down here, and eventually the market rolls over again. And the other thing I wanted to point out, which I think I kind of skipped it up here, was depending on your entry technique, right? So we've got the concept that we're looking for the break of the trend line, but obviously where do you place your order is one question to ask. You can see, if I zoom in a bit here, say this is we've got a one fractal, two fractal, right? We've had that big drop. We're feeling confident that this retracement is going to end pretty soon. See the price drop through here. If you have a, you know, if you enter at the market, or if you have a sell stop order below the trend line, then in this particular case, you're probably going to get stopped out. If your stop is above maybe the high here, it bounces up and makes a higher high. So here, the kind of market order below the trend line without waiting for the close on the of the 4-hour candle has given you a false signal. But then conversely here, if you were waiting for a close of the 4-hour candle, it would be right down here and give you a particularly, you know, a rubbish entry on the trade. So neither of these are particularly ideal situations. Probably if you had to choose, you'd go for, you know, maybe one stopped out trade and then one good trade. If you're looking at the benefit of hindsight here, you just have to know the kind of fallibility of your system in effect. If you are trading the breaks without the close, you're going to get stopped out more with false signals, but you're going to get better entries when the market does really just collapse and doesn't look back. But with that idea of looking back, I think a kind of halfway idea here that I tend to go for is, if it's ideal if you just get a close which edges just slightly below the trend line down here. Now you often get these pullbacks, but sometimes you don't. But you can just have to weather that small pullback with, if your stop's in a sensible place, then eventually you're still in a kind of good spot where the trend line's breaking. So you either have that small close right by the trend line, or if the close ends up right down here, you basically wait for a pullback. So in this case, we have the, you know, you can see that the 20 period moving average works pretty well. Or if you just want a simple technique, you know, you just chuck in the like a 50% or 61.8% retracement. And you can see in this particular example, it's the 61.8, which perfectly pinpoints where this trend resumes to the downside again. So you've had that dramatic candlestick lower, but you just wait for this pullback, and then you can have your entry there. So obviously the downside of the pullback technique is it may never pull back there, but if it does, you get a lower risk entry. In my opinion, waiting for a pullback that never might happen is better than chasing the market down here. Because if you're selling down here, yes, if the trend ultimately continues, you'll be right, but you have to risk too much if your entry's right down there, and you have to put your stop loss right up here somewhere. And you can see that this trend just, this process continues, and eventually, you know, the daily trend is going to reverse, and you know, obviously the last few trades you attempt, which are breaks lower to continue the downtrend lower, you know, they're not going to work, but that's the same as any trend following technique basically. And then obviously you get to stages where it's just a choppier market, and then you know, again, it's a matter of kind of just managing your risk for these multiple kind of choppy trades. So, you know, you have this, the market does break down, but then it pops up again. You know, then you maybe draw in your trend line like this. You know, the market does break lower, but it kind of barely makes it down to this support down here. you know, and you're kind of just waiting in essence for the next decent opportunity when this technique does work, keeping your losses small, and then eventually everything lines up, you get the decent entry point, and the market really does roll over to new lows. Now, as far as targeting your exits, it's really the same with any trading strategy. Your main options are trailing your stop loss behind the swings in the market. So you can either trail it. I wouldn't trail it behind the highs on the 4-hour chart because it's too choppy, but you could trail it behind the daily candles. So, you know, you get the trend line break, put it behind, stop loss behind that high, then behind that high, then you stopped. But you captured this little break move here. Obviously, you know, if it's something like up here, you get the close below, trail behind this road, trail behind here, and then eventually you're stopped out down here. So that's the kind of, the trailing technique is obviously best when the market just really falls off a cliff in the case of a downtrend, or just surges massively in an uptrend. That's when the trailing technique really comes into its own. You know, when it's a slightly choppier trend, that's when profit targets tend to work better, either based on extensions of the previous low using Fibonacci, or just previous areas of support and resistance, or just all round numbers. In this case, dollar yen particularly susceptible to round numbers, and I think that's part of why, you know, we've just come down to test 105. And I did mention in Monday's webinar that we've got this bullish engulfing pattern here, and so far it's getting a bit of traction, and we're moving above that previously broken trend line here. So we still haven't had a confirmation swing to the downside yet. So say, for example, here we may be lining up a break of this downtrend line, but obviously we're trading against our longer term trend for the time being if we do that. So I've gone through this dollar yen example. I didn't get any suggestions for just any other live markets, but I think that's fine because we've hit the half-an-hour mark here, so I'm going to call it a day right there. If you haven't done so already, obviously try the techniques out on a demo or live trading account. Right, thanks again, everyone. I hope that was informative. Any questions at all, feel free to contact customer services and they'll shoot it through to me. Cheers, guys. Have a great afternoon. Jasper signing out.